Okay, so here are the ground rules. Like I ask questions, Bobby asks questions, but if you think any of our questions are stupid and we should be talking about something else, tell us our questions are stupid and answer a question that you think we should be asking.
Please
Cool?
use the word stupid.
So Luke, do you keep like a dress shirt and your jacket like in the studio and then just put it on right away, or do you wear it all day?
I had a University of Cincinnati Bearcats hoodie on before I jumped on. So
Fantastic.
So
And
actually,
actually, I respect it that you put it on because I know you're like I know you guys are informal, but you still have a lot of clients who watch you. So if you want to be sharp, be sharp. I think that's very cool. I'm for it.
Luke's
Yeah.
clients are going to be like, "You're on with those two idiots again." I mean, what are you doing that for?
Let's begin. This is the Futures Edge podcast. I'm Jim Murio, as always, executive producer, brains behind the operation, co-host Bob Ichino. We have one of our favorite guests, and I was saying right before we started recording, the last time we had Luke on was last winter, and I remember closing it down and going, shit, we have an awesome podcast. We get great guests, and I really appreciate it. Luke, you were fabulous. You are the chairman and CEO of Forest for the Trees, FFTT Consulting, FFTT what?
FFTT LLC, yeah, it's a
FFTT.
macroeconomic research firm. Yes, sir.
A question that I want to say. I was just on Fox about an hour ago with Charles Payne, and I still think that the auction last week, the 30-year, which was not particularly well received, I don't think it's an enormous deal, but I think it's a bigger deal than people are giving it credit for, particularly in light of the fact that now we're talking openly about supporting two wars. Am I reading too much into it, or do you think it's a big deal, Luke?
No, I absolutely think it's a big deal. I think, I've been saying for a while, really started, we've talking about supply demand issues in treasuries for a while. In early August, when the Treasury did their borrowing update, third quarter, and I think they came out and said, we're going to borrow $1.85 trillion net over the next 6 months. That was a big number. And then you had Japan come out and say, hey, we're going to start taking the brakes off of the rails off of the yield curve control, kind of letting our bond market, our bond yields find a level, particularly on the 10-year. Then you had the U.S. downgraded, and you had oil rise 30% in a short span of time. I wrote in early August saying that 4 really destabilizing things had just happened. And by mid to late August was saying the beatings in duration will continue until the dollar is weakened meaningfully. And then I added, as we got into September, and oil kept moving, and oil is weakened meaningfully. And that's been my drumbeat, is the beatings in duration are going to continue until the dollar is marked down a lot. And so I think the 30 last week was a more aggressive symptom of that dynamic, which is ultimately the net effective supply of treasuries is not only greater than what people think, but it is rising non-linearly. And what I mean by net effective treasury supply is the dollar goes up, foreigners, by virtue of trade surpluses that they've recycled into treasuries over time, FX reserves, et cetera, foreigners in total own $7.5 trillion of U.S. treasuries. 3.8 trillion of that is at the central bank level. 3.6 of that is at the long end. They're notes and bonds. They're not bills. And so as the dollar rises, as oil rises, these foreigners in aggregate also have roughly $13 trillion in offshore U.S. dollar denominated debt. So every tick higher in the dollar squeezes them on their borrowing. And as you guys know, you don't always sell what you want to, you sell what you can. What can they sell? They can sell treasuries. You raise dollars to service your debt. When your oil bill goes up, when your gas bill goes up, like when we go to war in the Middle East or when we go to war with Russia or Iran or any of these other people, you end up driving the price of oil up, and they need oil and gas and commodities more than they need treasuries. And so what do? They sell treasuries. So every tick we have, so we have already this $1.85 trillion just for U.S. borrowing net in the back half of this year, which is an enormous number. I mean, it's a friggin' enormous number. But then the net effective issuance is not only higher than that, but it rises non-linearly, because every tick higher in the dollar, foreigners sell to raise dollars. Every tick higher in oil, foreigners sell to raise dollars. Every tick higher in rates, you end up, it puts more the whole system has been structured since 2014, whereby foreign central banks stopped growing holdings of treasuries in 2014, and there was a daisy chain of regulatory actions taken by the U.S. government that regulated first banks into buying more treasuries, then money market funds into buying more treasuries, then pensions into buying more treasuries, and most recently the Fed's raised rates to try to get U.S. retail to buy more treasuries. And so basically, everybody's already stuffed to the gills with these. And so the more the price of the treasury falls, your hedge funds are hitting stop losses and selling. Your banks, rates go up, the treasury value goes down, commercial real estate losses start to build. What do they sell? Well, banks in the United States are sitting on about $4.1 trillion in treasuries and mortgage-backed securities that they can sell to raise capital because they're taking losses on the CRE and soon on like everyone is like
to
stuffed
sell
to the
them
gills.
deep in the hole. It's like
right, and that's oh, by the way, the whole BTFP and bank crisis from back in March. Yes, it was kind of a bank crisis, but it was really not a bailout of banks, it was a bailout of the Treasury market, because the banks could have just said, all right, the Fed could have stood aside and said, tough, you guys bought that stuff, sell it. And what you would have had was banks coming in, dumping treasuries deep in the hole, writing down earnings, right? I mean, and it would have fed on itself at a time when you already had volatility in the treasury market was at near all-time highs. So I think the 30-year last week was simply one of the more, as we say in baseball, right? You buzz the tower, right? It was high and tight. It was up. It was a little chin music of buyers of long dated treasury. I mean, it is amazing to me. I give them credit because they get punched in the face, they get right back up, they get punched in the face again. It's like, oh, good, we're finally going to get a bid for this stuff. Here comes a war, great. This is going to drive a bid for safety. And my response, yeah, it did for a cup of coffee. I tweeted about this last week. I said, I mean, you guys know the phrase, right? Feed the ducks when the ducks are quacking, feed them. My response to that 30-year was, okay, I guess we've changed when the ducks are quacking, feed them, to when the ducks are quacking, shoot them with a shotgun and serve them for dinner. Because that was what happened. So is it a be all end all? No. I mean, I think tomorrow, given what the 10-year did today, this 20-year auction tomorrow could be a real friggin' adventure, especially given an escalation of the war.
Bobby, do you think, for the people who watch, should I give a 10-second, Luke speaks so high? So many people watch. So I'm just going to give, before you ask your next question, the Treasury is selling a shit ton of bonds because they're profligate spenders. That is forcing the price down, yields up. Everybody who's holding those bonds are sucking wind, and they have incentive to sell them as well. Bobby, you have the floor.
Yeah, I want a little PSA here, because our audience is mixed, right? Some people know exactly what you just said, but there's a phrase in there that somebody brought this up to me last week. Said, next time you have somebody on who can explain what they mean by duration, can you have them explain it? I think you're the perfect guy, because you just talked about lengthening duration versus shortening duration. Can you explain in as plain English as a Luke Gromen is capable? What do you mean when you talk about extending duration?
Why do you call him Gromen and I call him Gromen? What is the right way to pronounce your name?
It's Gromen technically, but I've been called a lot worse than Gromen.
I don't expect people to say Iacino correctly. If I expected people to say Iacino correctly, and technically it's actually Iacino, I don't even worry about how I say people's names.
Look who you're talking to. Yeah, right.
I know, buddy. Yeah, so explain what you mean by duration, just in plain English, if you could. And then I got a follow-up.
Yeah, so in plain English, duration, as I'm describing it, is a phrase used to describe longer term bonds. And the reason why that's important is because the longer term the bond, the more the price rises when interest rates fall, and the more the price of the bond falls when interest rates rise. So when you're talking about duration as it relates to this concept, you're talking about the length of the bond. And the reason why that's important is it gives you a sense of how sensitive it is to moves in interest rates.
All right. So the follow-up would be, what is your base case take today you mentioned what happened with the 10-year today. By the way, everybody, we're recording. Today's October 17th. You won't see this till the 23rd. And as of, I think last I saw 484, that's like the highest level on the 10-year since what, September 2006?
Yeah, something like that.
I mean, it's
Yeah, it
higher
broke
than,
back above the pre-war high. So it
yeah,
went up Friday before the Hamas-Israel war started at 479, I think. And that was sort of the, hey, okay, we're going to get a bid. And it got a bid 459, maybe 20 basis points, give or take.
yeah.
And right back up 485 a week and a day later.
So what's your overall take on that? Us being at this level is 2006, and you could take it to stocks, you could take it to the war, take it to fiscal policy, wherever you want to take it.
I think it's a symptom of an accelerating U.S. and Western sovereign fiscal crisis centered in the U.S. because we're running the biggest deficits. We are the center of the system. And in particular, that the long end, that the 10-year is doing what it's doing with the ISM below 50. And not just here, in Germany. I mean, Germany's industrial production is it's worse since 2020.
It's
and
like
in
43, wasn't it?
it
I went
it's
about
what's that?
43 last time.
Yeah, I mean, it is not just like a little recessionary. It is very, very recessionary. And so when you're seeing in these developed markets, these recessionary readings, the home builders index today, ISM, and it's a mixed bag in the U.S. to be clear. Retail sales today were very good, and I think that was a big part of today's sell-off. The bottom line is the U.S. has a fiscal problem that is too much spending, not enough demand for the paper, and given the centrality of the dollar in the system, this offshore dollar denominated debt I spoke about before, it's mechanical, but the higher the dollar goes, the more net effective paper for sale there is going to be. And it starts to get very nonlinear.
So my follow-up was this. I had a conversation with somebody today who said to me that the symptom of the long end going where it is not because people think inflation is going to go higher. It is literally the first step in the fall of the U.S. economy as a dominant economy because it's not inflation based. It's based on people just not wanting the paper.
I think it's the first step towards the Argentina with U.S. characteristics outcome that I've been looking for a long time. People have said, well, we've got all this debt. Only people with more debt than us are the Japanese, and we're just going to be Japan. We are diametrically opposite of Japan in terms of current account. They run a surplus, we run a deficit. The net international investment position, which is just a fancy way of saying piggy bank, right? They've run surpluses through trade with the world for 50 years. And so they've got a piggy bank of 65 or so percent of their GDP that in theory, basically they've got dollar assets, euro assets, mainly dollar assets that they can break the piggy bank, finance their own issues. We do not. We've been running deficits. That's how the system is structured. It doesn't make us necessarily bad. It just means we're the opposite side of that. They can call up Washington and say, hey, Washington, give us our dollars back now. We have an emergency. There is no piggy bank. Washington can't call Japan or Europe or India or China and say, we need our money back. There is no money. Their money's here. And so what that sounds like, what that looks like is rates go up and up and up until the Fed, the emergency bat phone goes right to the Fed and the Fed prints the money. So I think what we're seeing in the bond market, I agree, it is not an inflationary issue. The paradox all along has been that once you get debt to GDP to 120% in a twin deficit foreign financed nation like the United States, even if it has the reserve currency, when you have a net international investment position, a negative piggy bank like we have, because we've been running these deficits, the only way of avoiding a fiscal crisis, a debt crisis, is to run a sustained period of negative real interest rates. You have to basically inflate debt to GDP from 120% where it was 2 years ago down to 70 to 80%. Back in 2021, I calculated in a report that the math was simplified, right? All models are wrong, some are useful. model was basically, okay, we need to get debt to GDP from 120 to 70 to 80%. The reason I said that is 70 to 80 was the last time the Fed raised rates without really blowing something up, basically right away. It was also that 50% was also what the U.S. did from 46 to 51, 1946, 1951. Last time debt to GDP was over 100%, 110. They took it down to 50 in 5 years. U.S. real rates were at negative 13% at the lows. In other words, inflation was 13 points higher than the long bond. Got debt to GDP from 110 down to 55, and then you can separate Fed and Treasury, and Fed can run an independent policy, and away we go. Using that math, plus acknowledging that the U.S. debt has grown by 8% compounded annually since 2008. Every year, debt goes up 8% on average. I calculated that in early 21, that the Fed and Treasury needed to let U.S. real interest rates, in other words, they needed to let inflation run above the yield on the long bond by somewhere between 12 and 18% for 3 to 5 years. So basically, exactly, right?
Jesus Christ.
They'll lose their jobs, right?
Yeah, right. It's so and the crazy thing is, it looked like they were starting to do it. If you go back to 21, you're sort of like, hey, another stimulus. Everyone's going, wait, another stimulus? Wait, what? Yeah, exactly. And Bitcoin's going to the moon. Inflation's taken off. They're like, no, it's just transitory. These are not this is not the inflation you're looking for, right? And I thought they were doing it. In early 22, the Fed's, late 21, early 22, after Powell gets his job solidified, right? He says, all right, I'm going to raise rates. I'm like, no, he's not. And then it said, oh my gosh, yes, he's gonna. So for the first quarter of 21, I was totally wrong, because the math is very, very clear. If you run positive real interest rates with 120% debt to GDP, and twin deficits of 6 to 7%, or fiscal deficit of 6 to 7% of GDP, which is where we were back then, you're going to have a debt crisis. It is not even it's not even a question. It is a mathematical certainty. 1 + 1 is 2. The only question is when is it going to equal 2? And, by April of 2022, after the invasion, it was like, oh, he is going to do it. Okay, well then the only thing that's going to work is going to be the dollar for now. And you're going to see treasuries, you're going to see everything break. And I think what we're seeing is sort of that it's a mathematical identity. You can't have positive real rates with 120% debt to GDP, and we're now up to 8% of GDP deficit. So I think what we're watching, I would amend what that person said in terms of the end of our economy. I think it's simply the U.S. moving into a secularly inflationary environment, paradoxically caused by the Fed's rate hikes, because basically with a debt pile this big, if you raise rates, take a step back. In 2021, they did whatever, $1 trillion in stimulus, whatever the number was. I don't even know. But let's just say it's $1 trillion for an easy math. So one of the stimmy packages, one of the stimmies was $1 trillion, right? And it was deficit spent. Okay, great. That was $1 trillion in stimmies handed out to everybody. There's no functional difference between a trillion in stimmies and raising interest expense because the Fed raised rates by $1 trillion. It's the same. They're dollars. They're deficit-driven dollars. Now, who they go to is very different. The interest stimmy from the Fed taking rates to 5.25 that goes to wealthy asset holders and retirees and boomers. And there's articles talking about how the boomers are just out spending money like it's a giant YOLO trade, which I understand. It sort of is. But there's no functional difference between that stimmy and this stimmy. The only difference is this stimmy is like a morphine drip of interest payments every quarter. And this one is a shot into the jugular of instant, high grade heroin. And it's spent and it's gone and whatever, right? People put in Dogecoin and, buy a Lambo and a watch and do their thing, right? But so I think that's what we're watching is this mathematical. The Fed had the paradox is that the only thing that was keeping the U.S. from a debt crisis was the inflation the Fed spent the last 16 months fighting. And now we're on the wrong side of it.
So my question is going to be about gold and about central bank buying. I just want to put a fine point on what you just said. Are you saying that the only way out of it to reduce debt to GDP is for the government to practice some sort of level of austerity? I barely can say that word with our government with a straight face. Is that what you're saying deep down, right?
No. Well, it won't work because, without some sort of productivity boom. And here's why. You can do it if you do it soon enough, right? It's almost like, it's almost like you eat unhealthy, and now you're 400 pounds, and then you go and say, hey, I wanna run a marathon next week, and you're like, no, you're gonna you physically can't do it. Same kind of thing in terms of at 120% debt to GDP with an 8% deficit and 3.5% unemployment, they waited too long. And the problem is that let's say they cut the deficit from 8% of GDP down to 2, which is where it historically has been with 3.5% unemployment and when Volcker did what he did, et cetera. Okay, that means we need to take 8% to 2%, means we need to take 6 points of deficit, 6 points of GDP. That would mean GDP falls 6% immediately and permanently. Eventually, there would be a productivity gain down the road from getting the government out of the way and private, free. Okay, but that's down the road. When you have 120% debt to GDP, there is no down the road. You take 6 points of GDP up by way of now, you're going to get 6% of GDP decline immediately. You're going to get a recession to the tune of 6 points of GDP relative to wherever we're running. By way of comparison, the Great Financial Crisis, annually GDP fell 3, and it almost took out the banking system.
Right.
By way of comparison, in COVID, annually, I think GDP fell 6 or 8. And that was, we literally shut down the economy to get that number. So in theory, you can cut government spending because we've waited too long. The second derivative impacts you would actually see, and we saw this actually with Obamacare, right? So when Obamacare was technically a tax increase, the Supreme Court ruled it. In 2014, the Wall Street Journal said it was being done that would help reduce the U.S. government's deficit related to healthcare by pushing the cost of healthcare onto American consumers. Okay, that sounds good. Tax increase, reduce government spending, great. That was December of 2014. By the third quarter of 2016, the U.S. deficit as a percent of GDP was higher than it was in December 14. Why? Because people having to pay for their own health care meant they didn't go out and shop as much, so consumer spending fell, which was 2/3 of GDP, et cetera, et cetera. Dollar rose because we crowded out global dollar markets, because, there's these second and third derivative impacts, and that was at lower levels of debt, lower levels of deficit. So really the only way out is not cutting. The only way out, there's 2 ways out. There's some sort of productivity miracle, nuclear fusion, some widespread, portable nuclear fission, energy boom, something. Or because they didn't do it in 21, when it was 3 years of negative 12 to 20% real rates, it's probably 3 years of negative to 20 to 30% real rates for the next 3 years. Basically, you have to wipe out bondholders on a real basis, by and large, probably via some version of yield curve control, where the Fed just says, we'll buy every Treasury at every 10-year at 3. And as a practical matter, as you guys know, the market's going to go, oh, and every mortgage backer is going to sell themselves to the Fed. And then every piece of paper in the corporate market is going to sell itself to the Fed. And the Fed's balance sheet will go from 8 today to 11. 32. Yeah, 32 in 9 months. Wow. And the dollar will get killed, and it'll be it. That's the fix. And
okay. So here's my question, and I think this is important, because you mentioned gold a couple times before. This year, I'm sure you're quite familiar with the statistics. Global central banks have been buying more gold than usual. The last 3 months alone, buying a crap ton more. That's the official technical financial term, is crap ton. And the gold has rallied $100 in the last 2 weeks, despite the fact that real rates are the highest they've been in a long time, which gold hates, despite the fact that the dollar is rallying, and I do the rallying because it's rallying against those other bullshit currencies, for 12 straight weeks, it's put it in highs. Despite the fact that yields are going through the roof, gold has hung in. To me, that looks like, holy shit, the gold market kind of knows something and smells something out. I personally think trade above 1950, and I think Brent was saying last week he thinks that gold should be a cornerstone of your portfolio as much as 10%. I think the allocation should be a little higher. What are your thoughts on that?
Yeah, I think it should be higher. I think people in this environment, should probably have up to 20% of the portfolio in gold bullion, for a very simple reason. Now, gold, to me, to be clear, is useless for 99% of the long economic cycle. People say, well, gold doesn't do anything. That's exactly why you want to own it for that 1% of the economic cycle. When sovereign when there's a sovereign debt crisis, when there's a global sovereign debt bubble and it bursts, you want to own an asset with no counterparty risk, because ultimately the way sovereigns recapitalize themselves is by writing up the value of gold. Gold is telling us that the US and the West more broadly in particular, and really all sovereigns, have not just have a fiscal problem, but that it is acute. The fact that gold has completely diverged from real rates in a way that it hasn't in 20 plus years. In the United States, by the way, rates in Argentina are at 133% and gold looks like this. Is the US going to be Argentina? No. Is the US suffering through something that Argentina went through 20, 30 years ago, that Brazil went through 20, 30 years ago? Absolutely, 100%. Does that mean we're going to end up like them? I don't know. Probably not. There's some things that are different. But what gold is telling us is the U.S. has a fiscal crisis. The U.S. has a fiscal problem. And yeah, I think gold is a must own for this part of the long debt cycle. The only way the U.S. can pay entitlements, which are nearly 70% of receipts, Treasury spending, which is another 25, 30% of receipts, and defense, which is another 20-25% of receipts, right?
You say Treasury spending, you mean debt service, right?
Just debt service. Yeah. Current year debt service. You're over 100%. So you can't pay just those big three out of tax receipts on a sustained basis. And you say, well, great, we'll just crowd out the world. Again, okay. But that then means the dollar goes up. And we just talked about at the beginning of the show. What happens when the dollar goes up? Foreigners have $7.5 trillion they can sell, and they will until their hands bleed, right? The old yours.
I still can't say the word sold without doing that, right?
All us old timers, right? Till their hands. Yeah. And so the dollar will go up, and then rates will go up, and the rates will keep going. And at some point, the U.S. Fed will face a choice of, the only thing we can afford, there's a rate where mathematically, the only thing we can afford is interest. And if you think the Fed is going to stand aside and lay off the Marine Corps and the Navy and the Army and tell 70 million baby boomers, sorry about you, there's zero chance that's going to happen. The Fed's going to print the money, or the Treasury will print the money. One way or another, it's going to get paid. So that is ultimately the message of gold. Gold's just looking at, hey, okay, entitlements are almost 70%, interest is 30, there's 120 is defense. Then we got national parks, education, labor, Veterans Administration, all this other shit. Gold's going, you know what? The more rates go up, the more insolvent they're becoming. I'm not selling my gold. The last thing you want to do is sell your gold.
Luke, you just mentioned a second ago how Obamacare was a tax hike, Supreme Court ruled it, and how GDP suffered. One way people think we can get past this is, you see the smile creeping up, is by raising taxes. How can you explain to people that you mathematically simply can't raise taxes high enough to do that?
You couldn't do it across the board to people for exactly that reason. Is you're going to have
couldn't do just the rich to pay for this, right?
That would be the one way where you in theory, and let me be clear, I'm not advocating this in any way.
We know you're not. We want to make sure everybody listening knows you're not.
That's all I need is that headline.
All your clients. Because your clients aren't poor people, is my guess.
In theory, if you look at the math and the concentration of wealth in this country, right? So the boomers own $35 trillion, and it is subject to some version of the 80-20 rule, right? And they have 35 trillion in assets, give or take. Maybe it's 30, maybe it's 25, whatever. It's a big number. There is a world where, in theory, you say everybody who has a net worth over, let's say it's $20 million. If you're worth more than $20 million, you have to pay some sort of one-time, very big wealth tax. And that is what people look at and say, well, if we did that, then that would get us $10 trillion in taxes and we could buy back the debt. And look, in theory, yes. However, again, you get into these second and third derivatives where, wait, that's collateral for this and this is collateral for that. And that means that has to be sold. That's what happens when you built a system that's based on debt rather than a sort of a neutral reserve asset. So every asset, every debt is somebody else's asset. It sounds good, but it just can't work. Even if you could do it politically.
It's just that thing that people think that somebody who's worth $20 million has $20 million. Like they just have it
No.
in an account.
Yeah, well,
Like,
tell
look,
me the day when Jeff Bezos has to sell 2% of his stock. Tell me when that's going to happen to meet his tax obligation, because I'm going to front run the shit out of it. That's what we do. You know what I
right,
mean? Yeah.
right.
And I make no apologies for that.
Nor should you. It's not illegal. You know that
Right?
Nancy Pelosi would be doing it too.
Damn, she'll do it illegally before it's even announced. I'm waiting till
Yeah.
after, at least.
And I'm
Yeah.
sure there'd be Republican Congress people doing it too. I don't want to get weird here. But
Oh, yeah, no.
so from a perspective of that, the follow-up question to that becomes then the gold story, as Jim mentioned it. I see gold as, okay, so Larry Fink yesterday, Jimmy, I was talking to Luke about this before we went on. Larry Fink yesterday said that Bitcoin is starting to act like a flight to quality asset. And I was on CoinDesk TV this morning and I corrected them. I said, he's mistaken. He's been out of the trading side of it for a very long time. And Larry said flight to quality, he meant flight to safety, right? But I argue that gold is both, right?
Yep.
Gold is a quality asset as well as being your basically your best flight to safety asset, because it not only is the background of, gold is likely to rise in this scenario, but gold is a return of capital asset. Period.
Yep.
End of sentence.
Period. End of sentence. Yeah.
Yeah, Warren Buffett likes to say, "Oh, gold doesn't make anything; it doesn't pay a dividend." Fuck you, Warren. I mean, seriously,
no doubt about it.
You don't have.
He doesn't drink 9 cherry Cokes a day. That's the most bullshit thing I've ever heard. That he claims he'd be dead. I know he's alive.
Gold pays a yield too if you lease it out and take the risk of not getting it back. That's the part they all
That's the part they always miss, right? And you're talking about,
if my money's in the bank earning a return, it's because I'm a general creditor, and if I've got more than 250 over there, I could lose my deposit. That is a risky. I'm taking a risk.
Yeah, and from that perspective, I mean, you don't have CEO scandals. You don't have the CEO sleeping with an intern that's going to hit the stock 20% when that comes out. Gold. So the reason I'm saying this, I called gold as my trade of the year in November 2022 on a forward look panel that I was on. And the other 3 people on the panel kind of chuckled, and I was like, look, you guys are missing the point. When you're talking about the best performing asset, it might mean that everything else is down. Like everybody's always like, oh, AI is going to outperform. Yeah, until it doesn't, then it's going to underperform badly. So that to me, I mean, am I crazy to think that I have a lot of gold right now. So I'm talking my book, just for the record. And am I crazy to think that, I think that's my trade in the next 10 years?
No, and here's why. And this is the part that I am consistently, my interpretation at least, or what I think I'm seeing, which is for the first time in any of our careers, and in the career of anybody really probably as old as Buffett or maybe just slightly younger than Buffett, the risk.
That's everybody, by the way.
It's everybody. Exactly. Yeah, sorry. And for the first time in everyone's career, the risk-free asset has either inflation risk or credit risk, based on what I just said. We can't make ends meet without printing the money. And if we don't print the money, the price of the bond is going to go down a lot.
That's huge.
So they either print the money, which is good for gold, or $100 trillion of bond value, 130 really, which is based off of a Treasury bond, is all going to get marked down. And what happens to the value of gold when the $130 trillion bond market figures out, holy crap, hey, have counterparty risk, because the risk-free asset in the capital asset pricing model only doesn't default if they print the money to keep it nominally money good. It's kind of like a lot of things we've seen over the last several years where the government tells us something and we're supposed to believe it just because the government tells us that. And it's the same way where I see a lot of, and there's different time frames in trading, right? There's traders who are short term, there's long term, across the spectrum. But almost everybody looks at it and goes, that's risk-free collateral because those people told me it's risk-free collateral. And my regulator says it's risk-free collateral. And what else have they
Those banks thought it was risk-free collateral too until they put it in their, hold the maturity current. And all of a sudden it's down 30%.
Yeah. It's down 30%. And again, it either has inflation risk or it has credit risk. And this is what happens to, I mean, it's a fascinating thing to me. There was so Reinhardt and Rogoff, they did a study called "This Time Is Different." 500 years of debt, sovereign
I
debt
read that
crises.
book. Yeah.
It's a great book, and a guy named Brian Hirschman runs Hirschman Capital. Took some of the data and looked in summer of 20 when U.S. debt to GDP peaked around 130%, and he said, going back 120 years using their data, there were 54 countries that hit 130% debt to GDP. Out of those 54, 98%, 53 out of 54, defaulted on their sovereign debt usually via sustained high inflation, a few markdowns of restructurings, couple hyperinflations. But you guys know, in our business, 52, 55% is friggin' unbelievable. You take those odds. 60, oh my God. 98% odds don't come around in this business. And oh, by the way, the one country that hadn't when he wrote that was Japan. And we can all look at Japan and go, well, Japan's, that whole, maybe Japan's in trouble now too. So really the number is 100%. Once you get to these levels of debt and deficits, particularly when you are a twin deficit nation, even if you're the reserve currency, because guess what? The Brits went through the same thing after World War I. They borrowed a bunch of money, they did a bunch of dumb shit, and they inflated their debt away.
If we finish here, this is going to be the third consecutive year of losses for treasuries, and that's never happened.
It's never happened.
Never happened. That to me was shocking to hear. And so this time is different. It's already different.
That's exactly. And the other thing that grabbed me about it too is it's not like, I used to sit, I was in equity sales. So I sat right next to equity traders, right? So you see, big seller, big seller, big seller. And someday there's like, okay, we're cleaning up a big seller, right? So, okay, big seller's done. Okay, maybe the stock can breathe. Okay, let's see how it trades now the big seller is done. We saw it last week with the 30. Another 20 billion ready to go. They aren't going to run out of shit for sale ever. And if the dollar keeps going up, it's going to be, hey, U.S. Treasury's got 20 billion for sale. And it's, Japan defending the yen. Israel defending the shekel. U.S. banks because they're taking losses in commercial real estate. U.S. pensions because they got a bunch of retirees. Everybody owns this stuff already. There is so much supply that is net effective supply that is not added into the already eye-watering amounts of supply just coming from Treasury. So there's never going to be cleans up a big seller call in that market. Like it's the only one with the balance sheet to do it's the Fed, which goes back to then gold.
Right. Hold it though. So now gold, we talked about gold and I agree 100%. So let's talk about other risk assets, i.e. stocks. Because I've heard all you said and I'm like, shit, well, rates going higher because they're selling a shit ton of bonds, can't own stocks. But then I'm thinking, can you not own stocks if the dollar is going higher, it looks like, but really we know it's going to shit because of all the blown up balance sheets around the world. So what is the implications for stocks?
For me, the implication for stocks is higher on high volatility. I saw a headline go by today. Argentina Merval index up 5% to all-time record today. Yeah. In local terms.
Yeah, you got to be long the peso, right?
Right. Rates in Argentina, I think the central bank just raised them to 133% last week. That's what happens when you're a twin deficit nation and fiscal dominance. It's not going to be exactly the same because we're the reserve currency, a much more diversified economy, blah, blah, blah. Whole bunch of, but directionally, what it suggests is the longer we go down this path and the more obvious it becomes that, oh my God, they can't make ends meet without printing the money to make the ends meet in sort of these big three expenditures. The more you go from 60-40, which is where everyone in the world, they're 60-40 and they're 40-60, right? 60% equities, 40% bonds, or vice versa. You can't own long-term bonds. You can't. You start shifting allocations out of long-term bonds into equities. And, the bond market roughly is, I don't know, it's at least twice, maybe 3 times the equity market here in the U.S. So I think you'll see equities fall in gold terms. I think you'll see equities fall in Bitcoin terms. I think you'll see equities rise in dollar terms and rise against bonds.
What about real estate?
I think real estate will be a case-by-case issue, depending on location, depending on usage. Generally speaking, I think it probably goes higher. overall. I mean, you just take the average piece of, basically, I think you're going to want real estate that people with lots of stocks want. I think those pieces of real estate will do really well. Then it's more hit and miss after that.
Okay, I want to say something before I give Bobby the next question, but we talked about earning rate of return on gold. We talked to Brian London last week, and he brought up something that was brilliant. And I have a lot of gold, physical gold. You can technically earn a rate on that if you want to sell calls against it in the future. My call spreads against it because you don't want to be called out and whatever and be screwed. But if you sell things against it, if you're willing to pay that money if you lose on that, because your gold will be going up in value huge. So it is possible. But Bobby, what do you got?
Yeah, I wonder if you can touch on commodities at all, Luke, because I got a pretty strong price action pattern to the upside in crude. And one of the things I do when I get one of these price action patterns is I start to look at what in the fundamentals could trigger it. Right now, the pattern's already triggered. It's predicting a shoot up to about 92.17. So let's just call it 92 in WTI. And that's the November futures contract. And when I look at it, I see an acceleration of, I'm just going to call it a conflict. I don't even really want to talk about it, but the Middle Eastern conflict, so to speak. Biden's going over there, which in theory means more of a sort of conversation about rather than battle, right? Diplomacy, as they call it. I don't see anyone there with a diploma in their hand, but whatever. And I look at it from a perspective of the Russian central bank said today that they reiterated that OPEC Plus is likely to increase production in the beginning of 2024. I don't buy that for a second. It wasn't Novak. It wasn't Putin. It wasn't anybody in the know. What else would hurt the U.S. as they support Israel, support Ukraine more than $100 crude? Now, I had a crude oil long. I covered it at 91. I got it on August 31st. I remember the day I got in, and I covered it at 91. It's a good trade. And I'm sitting here waiting, and I see this pattern, and I'm like, okay, the fundamentals to me, end of summer driving season, et cetera, overall, commodities themselves, in a slowing environment, is crude the only one that can go up, or is it some hidden thing I'm not aware of?
I think there's probably some of the softs can go up given conflict-related stuff, the weaponization. You
like
get the
wheat
usual
in Ukraine, for instance.
Wheat in
right?
Ukraine, exactly. Gas,
We
that
already
kind of
talked
stuff
about
could be
gold. Figure
weaponized. Weather.
silver
Yeah.
and gold together, so not those, but copper.
When I look at what's happening with housing, in terms of like the National Association of Home Builders is starting to get pretty sloppy on the downside. I think it's a story of sort of short-term industrial demand being a drag on copper. And then you look at sort of the intermediate and longer-term supply side. There was an article last week in the FT where one of the biggest copper producers in the world is like, we can't find enough of this stuff to even get close to hitting the EV targets we need to hit. So those are the two balances. So to me, from a commodity standpoint, the oil side, I think, is the most interesting. Sadly, partly because of this conflict. I mean, it's very interesting when a lot of people have poo-pooed sort of the BRICS and the leverage they have or whatever. Okay, I look at Russia and I look at Iran, and they combined control 23% of the global oil export market. The United States couldn't cut a fifth of that number without sending oil to 150. In my opinion, maybe 120, but whatever, a lot higher. Because I'm adding a preciseness. It's a wild ass guess. I don't know what the number is, but a lot higher, let alone the whole thing. So you're in this very delicate situation where you're fighting in Ukraine and the Russians have whatever it is, 17%. The Iranians have 6%. You're dancing with them. Don't let Hezbollah in there. We're trying to talk. You can, in my opinion, the read through of U.S. reticence. I thought it was really interesting last week. Wall Street Journal was out within 36 hours of the attacks. And boom, they're running a front page story. Iran helped them. And within 24 hours, the administration was backtracking. And I think part of the reticence of the U.S. administration to just tar Iran with this brush, I think, is the realpolitik around if oil goes to 120 here, 110, 120 here, if there's an OPEC oil embargo, the Treasury market, that gif of the doll throwing up all over itself, it's like that's going to be, the Treasury market will blow up. So I think there is, and then furthermore, you see later this week, what are we doing? We're going down to Venezuela. Hey, best buddy, I know we've been
Oh,
prepping
geez,
this
I
for
saw
20
that.
years,
I'm so glad you brought that up. That was
right?
crazy.
So
But
like,
anyway, go on. Yes.
yeah, so like I don't think that's a coincidence. It's interesting you say that in sort of like the tactical trigger pattern on oil, because I look at this, and if I'm Putin, Louis Gavin, a great point. It's like, what, he was on Macro Voices, and he said, she has bought up a bunch of oil, and people say, oh, he's going to invade Taiwan. And maybe he is. I don't think so, but Louis proffered an alternative theory, which is Putin gave him the heads up and said, hey, this winter, we're going to properly weaponize oil. You might want to buy oil and gas ahead of this.
Oh, that's
winter.
really interesting.
So it's with the when the narrative and the tactical signals start matching up, I think it's something you have to pay attention to.
Luke, can I show you a reverse repo chart and just kind of get your take on it? And again, this is like a public service announcement. Yeah. Yep. So what do you make of this?
Take this with a grain of salt, because I am just know enough about this to be dangerous. This is effectively money that was sterilized by the Fed to prevent it from going out into the economy and creating inflation, which is now being drained and flowing into basically T-bill markets to finance the government. So basically, when you see Yellen say, hey, I'm going to issue more in bills, in the context of this chart, my read of that is Yellen's real message should say, oh, shit, I can't issue more at the long end. Do you see what the long end's doing? Where's my cheapest, easiest source of liquidity? Issue more bills. And so I would look at this as a fuse, if I'm right in terms of that interpretation. This is sort of a fuse. As that number gets close to zero, you should start to see more fireworks in the Treasury market, more volatility in overall asset markets, the Fed jawbone, no more rate hikes, more trying to jawbone the dollar down. And I think ultimately the way that ends is the Fed going back to QE or some version of it, regardless of where oil is, regardless of where gold is, regardless of where stocks are, regardless of where inflation is.
In my 36-year career, that like 3 different times I've known exactly what the repo and reverse repo market means and the implications, and then I forget it for about 5 years, and then when it comes back, I got to relearn, like, what is it again? And I don't know why I have this mental block. It's probably like trading options. You stop trading options for a couple of years, I imagine you forget some of the characteristics of them as well, right? So,
I mean, when banks have excess cash, when banks have excess cash, there's no reason for it to just sit there. So they go into short-term interest-bearing vehicles at the Fed, and then they get it back the next night. That's reverse repo. And when I see that chart just headed down, like Luke said, there's less and less cash at banks to do this.
That's the way. If they keep raising the rates on reverse repo, if the Fed does, that's a way of draining liquidity from the system.
Yes.
Right. And
the opposite. It gets closer and closer to zero, that vehicle goes away.
Yeah, that vehicle is basically financed. Yeah, because it's in reverse repo or it's in T-bills, basically, money market T-bills. So it's sort of like 6 of one, half dozen of the other. They're in short-term cash, but the T-bills are, I think, explicitly financing. They're giving Yellen an ability to finance these deficits as they're coming through.
And in a way that set the lower bond of the rate range, right, is through reverse repo. That's where they set it.
And I mean this. I say it on our Trade Year podcast as well. You could think Bobby and I are dumbass, but we get kick-ass guests on the show. Thank you so much.
And actually, you are one of 3 go-to people when I'm trying to get people on the show. I'm like, we've had Jim Bianco, Cameron Dawson, Luke Gromen, not in that order. You're one of the people that I put out there where people are like, you've had Luke on? Oh, yeah. Okay, I'll come on. You're literally one of those people.
Oh, I appreciate it.
That's really cool.
Thank
you very much, Luke. It's always great to talk to you.
I enjoy talking to you guys. It's always a lot of fun and great format. So really enjoyable.
Awesome.